You are waiting for a crash that has already happened. Right now, millions of people are holding cash, waiting for the housing market to pop. They are waiting for the stock market to drop 40% like it did in 2008. They are waiting for the moment when panic hits the streets. But I need you to listen very carefully to what I am about to say. The crash of 2026 will not be a loud event. There will be no Lehman Brothers moment on the evening news. There will be no lines of people trying to pull their money out of banks. The numbers in your retirement account might even go up. The value of your house on Zillow might stay exactly where it is. And yet, by the end of 2026, you will be significantly poorer than you are today. This is not a paradox. This is a design feature of the new economic system. Welcome to the era of silent liquidation. In the next 20 minutes, I am going to show you the mechanics of a theft so sophisticated, most victims thank the thieves. I will show you the specific page in the banking regulations that legally turns your savings into their property. I will explain why the government has no choice but to confiscate your wealth to save itself. And most importantly, I will show you the only way to opt out of this system before the trap snaps shut. This is not about fear. This is about the cold, hard math that runs the world. The money illusion. Let's start with the greatest magic trick in financial history. It is called the money illusion. Human beings are wired to think in nominal terms. If you earn $50,000 this year and $55,000 next year, your brain says you are winning. You have more dollars. But dollars are just a measuring stick, and the government is shrinking the stick. Let's look at the data from the last 4 years. Since 2020, the official CPI inflation has accumulated to over 20%. But if you measure inflation using the methodology from 1980, before they changed the formulas to look better, it is closer to 40%. Think about what that means for your life's work. If you had $100,000 saved in a bank account in 2020, today, that money has the purchasing power of roughly $60,000. You didn't lose a single dollar. No hacker stole your password. The bank didn't go bankrupt. But $40,000 of real value simply evaporated. Where did it go? It didn't just disappear. It was transferred. It was transferred from you, the saver, to the government, the debtor. This is not a conspiracy theory. This is a textbook economic policy. It has a name. Economists call it financial repression, the mechanism of financial repression. To understand what is coming in 2026, you have to understand financial repression. This is the playbook the United States used after World War II to pay off its massive war debt. And it is exactly the playbook they are running right now. Here is how the mechanism works. The government has too much debt. Currently, the U.S. national debt is approaching $36 trillion. The interest payments on that debt are now higher than the entire defense budget. They have two honest ways to fix this. Option 1. Default on the debt. Tell the world they can't pay. This would destroy the US dollar and global status immediately. They will never choose this. Option 2. Austerity. Raise taxes massively and cut spending on Social Security and Medicare. This would cause a political revolution and riots in the streets. They will never choose this. So they choose the dishonest way. Option 3. Inflate the debt away. They keep interest rates lower than the rate of inflation. Let's do the math. If inflation is running at 5% and the government pays you 3% on your bonds or savings, the real interest rate is -2%. That -2% is a tax. It is a liquidation tax on your wealth that requires no legislation. It requires no vote in Congress, and most people never even notice it is happening. They just notice that their grocery bill is higher. They notice that insurance premiums just doubled. They notice that they are working harder but falling further behind. This is the silent liquidation. But here is where it gets worse. Historically, this repression lasts for decades, not years. Between 1945 and 1980, the U.S. liquidated roughly 3 to 4% of its debt annually through this method. Today, with debt levels at 120% of GDP, they need to run this play faster and harder. They need to liquidate 5 to 7% of your purchasing power every single year to stay solvent. By 2026, the cumulative effect of this policy will mean that $1 saved in 2020 will buy less than 50 cents of goods. Half of your labor, half of your sacrifice, gone. And here is why 2026 is the critical deadline. A massive wall of corporate and government debt is maturing between now and 2026. Trillions of dollars that need to be refinanced. The system cannot afford to pay real, positive interest rates on that debt, so the Federal Reserve must engineer a period of sustained high inflation. They will tell you they are fighting inflation. They will raise rates slightly. They will give tough speeches. But watch what they do, not what they say. They will ensure that inflation runs hotter than interest rates for the next decade. Your savings account is the fuel they are burning to keep the engine running. The bail-in danger. Now, let's move from the invisible theft of inflation to the visible theft of confiscation. Most Americans believe their money in the bank is safe because of the FDIC. They believe that if a bank fails, the government writes a check. That was true in 2008. It is not true anymore. After the 2008 financial crisis, global regulators realized they could not afford another bailout funded by taxpayers. The public anger was too high. So they changed the rules. They passed the Dodd-Frank Act in the United States. And similar laws were passed in Canada, Europe, and the UK. These laws replaced bailouts with something called bail-ins. You need to understand the legal distinction. When you deposit money into a bank, you think you are storing your property, like putting a gold bar in a vault. But legally, that is not what is happening. Under the law, once you hand your cash to the teller, it is no longer your money. It becomes the bank's money. You become an unsecured creditor of the bank. Your bank statement is just an IOU. It is a promise to pay you back if they can. But what happens if they can't? Under a bail-in scenario, the regulators have the authority to convert your deposits into equity. This means they can take a portion of your cash and give you bank stock instead. Stock in a failing bank. Stock that is likely worthless. You might think this is impossible in America. You might think I am fear-mongering. But it has already happened. Look at Cyprus in 2013. People went to sleep on a Friday thinking their money was safe. They woke up on Monday to find the banks closed. When they reopened, depositors with over 100,000 euros lost 47.5% of their savings. It was simply confiscated to recapitalize the Bank of Cyprus. It was legal, it was planned, and it was executed over a weekend. The FDIC in the United States only has about $120 billion in its insurance fund. That covers roughly 1.2% of all insured deposits. If we have a systemic crisis in 2026, which the math suggests we will, the FDIC cannot cover everyone. They will have to trigger the bail-in protocols. But wait, there is another layer to this trap. Central bank digital currencies, or CBDCs. While the bail-in framework is the legal mechanism, CBDCs are the technological mechanism. The Federal Reserve is currently testing FedNow and exploring a digital dollar. Why does this matter for the silent liquidation? Because a programmable currency gives them absolute control over velocity and expiration. Imagine a stimulus check that expires if you don't spend it in 30 days. Imagine a savings account that charges you a negative interest rate directly. You can't withdraw cash because there is no cash. You can't move to gold because the purchase is blocked. This is the ultimate endgame of financial repression. Total enclosure. By 2026, the infrastructure for this digital control grid will be fully operational. They won't force you to use it at first. They will incentivize you. Sign up for the digital dollar wallet and get a $500 bonus. But once you are in, the doors lock behind you. This is why money in the bank is not the safe haven you think it is. In a solvency crisis, your asset becomes their liability, and liabilities get restructured. The systemic trap. Why is the system rigged this way? Why does it feel like the middle class is being targeted? Because you are. The middle class is the only group with enough liquid wealth to pay the bill. The poor have no assets to confiscate. The ultra-rich have their assets in tax havens, trusts, and complex legal structures. They own businesses, land, and art. They don't keep millions in savings accounts. The middle class keeps their wealth in paper. 401 kiloseconds. Pension funds, savings accounts, certificates of deposit. These are all counterparty assets. They rely on someone else's promise to pay. And right now, the counterparty, the U.S. government, and the banking system is technically insolvent. Let's look at the debt spiral. The U.S. government is adding $1 trillion to the national debt every 100 days. This is exponential growth. In nature, exponential growth always ends in collapse. There is no mathematical way to pay this back. So, the planners in Washington and Wall Street have made a choice. They have chosen to sacrifice the currency to save the bond market. They have chosen to sacrifice the saver to save the debtor. This is why 2026 is so dangerous. It is the convergence point. Commercial real estate loans are defaulting. Regional banks are sitting on massive, unrealized losses. And the government's interest bill is exploding. Something has to give. And that something is the purchasing power of your dollar. They are going to print the money to fill the hole. Trillions of dollars. This new money will dilute your savings, just like watering down soup. You will still have a full bowl, but there will be no nutrition in it. This is the silent liquidation. The anti-fragile strategy. So, what do? How do you opt out of a system that is designed to drain you? The answer is not to hide cash under your mattress. Cash is the victim. The answer is to own things that cannot be printed. You need to move from paper assets to hard assets. This is what the wealthy have always done during periods of currency debasement. First, consider gold and silver. I am not talking about a paper ETF that tracks the price of gold. I am talking about physical metal that you hold in your possession. Gold is not an investment. It does not pay dividends. Gold is insurance. It is the only financial asset that is not someone else's liability. If the bank fails, your gold is still gold. If the dollar collapses, your gold reprices higher to account for the inflation. It is your shield against the silent liquidation. Look at the central banks themselves. In 2024 and 2025, central banks bought gold at the fastest pace in over 50 years. China is dumping U.S. treasuries and buying gold. Russia is hoarding gold. Even Poland and India are stacking bars. Why? Because they know the dollar is being debased. They are exiting the system they built while telling you to stay in it. Do what they do, not what they say. Second, look at productive land, farmland, timberland, even a rental property with a fixed-rate mortgage. Why? Because debt is the short position on the currency. If you have a 30-year fixed mortgage at 4% or 5% and inflation goes to 10%, the bank is paying you to borrow money. The real value of your debt is shrinking every year, while the nominal value of the asset rises with inflation. You are using their game against them. This is how you turn financial repression into financial freedom. You become the debtor holding the real asset instead of the saver holding the paper liability. Third, you must become essential. In a depression, luxury services die. Essential services thrive. Invest in skills that solve real, physical problems. Repair, energy, food production, health. The economy of 2026 will not care about your marketing degree. It will care about what you can actually do. You need to build a personal supply chain. Can you fix your own car? Can you grow a portion of your own food? Can you generate your own power? These aren't prepper fantasies anymore. These are rational economic decisions in an era of supply chain fragility and currency collapse. Dependency is vulnerability. Self-reliance is the ultimate wealth. The choice is yours. The year 2026 is coming whether you are ready or not. The math has already been written. The laws have already been passed. The leverage has already been built. You cannot stop the tide from coming in, but you can decide where you build your house. You can stay in the paper world, trusting the banks, trusting the government, and hoping that this time will be different. Hoping that the silent liquidation won't touch you. Or you can move to the real world. You can take possession of your assets. You can reduce your counterparty risk. You can prepare for the storm. The difference between a tragedy and an opportunity is preparation. Look at your bank statement today. Really look at it. Do you see wealth, or do you see a promise from an insolvent system? By 2026, we will all know the answer. Don't be the person who waited for the crash on the news, only to realize the crash was in your wallet the whole time. If this message resonated with you, if you feel the cost of living tightening around your neck like a noose, then you know I am telling the truth. In the next video, I'm going to break down the specific hard asset shield. I will show you exactly how to allocate a portfolio to survive a decade of high inflation. Subscribe and turn on notifications. Because the window to act is closing, and you need to be on the lifeboat before they lock the doors. I'll see you on the other side.